Running a small business is a blur of immediate actions. You organize receipts and pay bills. But surviving the daily grind doesn't mean you're turning a profit. Today's cash is just one data point in a system reaching far beyond your bank balance. To make sense of all that raw data, we rely on a mathematical law that governs every business on Earth. This scale represents the accounting equation. Everything your business owns, your assets, must rest in perfect equilibrium against everything it owes, liabilities and equity. When a daily action hits, it instantly splits into two equal and opposite entries. If you buy a piece of equipment, your assets go up, but your cash goes down by the exact same amount. The scale never tips. The mechanism that continuously feeds your daily operations into this equation is called the accounting cycle. Without this system, a business is flying blind. Financial accounting converts chaotic daily actions into a stable, mathematically balanced reality. Step 1 of that cycle is journaling. We need a rigorous framework to take a physical invoice or a cash payment and translate it into mathematical data. This matrix breaks down a foundational framework called Dealer. It separates your accounts into two distinct categories to handle double-entry bookkeeping. On the left are your normal debit accounts, dividends, expenses, and assets. On the right are your normal credit accounts, liabilities, equity, and revenue. When you make a $100 sale, the transaction routes through the framework. You record a $100 debit to your assets because your cash increased, and an equal $100 credit to your revenue. Once those journal entries are recorded chronologically, they move to step 2, the general ledger. Look at this physical ledger from 1911. Even a century ago, clerks had to take thousands of raw inputs and sort them into designated categories to keep them organized. Today, we use T accounts to do this. Think of them as individual buckets within the general ledger that tally up your total cash, your outstanding liabilities, and your total revenues separately. By combining chronological journal entries with the categorized buckets of the general ledger, the system ensures that no piece of financial data is ever lost or unbalanced. Step 3 arrives at the end of the month, the trial balance. You check your bank and credit card statements to ensure that your total debits perfectly equal your total credits. However, there is a catch. Your math can be absolutely perfect, yet the data can still mislead you about the actual state of your business. If you use cash accounting, you only record data when money physically moves. But to see the true performance, major companies use accrual accounting. This dual-track timeline illustrates the core rule. Revenues and expenses must be recorded when the work is actually done, regardless of when the invoice is paid. A customer might pay you in October on track A, but if you don't actually perform the service until November on track B, your data is out of sync. To fix this timing distortion, we use step 4, adjusting entries. We hold that cash payment on the balance sheet and shift it across the timeline into your actual income column only when the work is complete in November. This logic applies to prepayments, where cash moves before the work is done, and accruals, where the work happens before you see a single dollar. Adjusting entries bridge the gap between bank balances and economic reality, ensuring the books reflect when value was created, not just when cash was moved. Finally, we reach the quarterly and annual stages of the cycle. The raw, adjusted data is solidified into formal external reports. These 3 models represent the big 3 financial statements, all generated from your central pool of translated data. First is the balance sheet. It freezes the fundamental equation at a single point in time, giving you an exact snapshot of what you own and what you owe. The income statement measures your profitability over a specific period of time, and the cash flow statement tracks your actual liquid cash. As a business owner, you generate the daily chaos, the sales, the expenses, and the physical operation, but your accountant applies the structural engineering. Financial accounting is the translation system that turns messy daily reality into precise evidence for making decisions.